I'm very excited about this meeting today because we're going to be sharing some really good stuff about how you could buy a home with just using your rental history. This is a program that's funded by Bank of America, so it's a very, very good program. So there's a company called NACA. It's Neighborhood Assistance Corporation of America. And what this program does, it's a non-profit organization. It is HUD certified, and they help homeowners, or they help people who are currently paying rent to be able to buy a home without having too much of a credit issue. So NACA's premise is, as long as you can afford to pay rent, then you should be able to purchase a home, right? And that's kind of what they go by. And they do have different programs. They have workshops. They teach you how to become a homeowner and that kind of thing. So it's a process. I don't want to get ahead of myself while I'm just trying to fill the gap while we wait for a few more people to come on. We're going to be starting in about a minute. But they kind of fill the gap. So they teach you how to be financially responsible, how to the joy of home ownership, and also the cycle that it takes to purchase a home through them, which is really awesome. They have been around for many, many years. I used to work with them in New York, and I just recently started working with them again here because I did not realize they were also in Florida. So they are. Which is awesome. So let's get started. So NACA again is a Neighborhood Assistance Corporation of America. That's what they are. And they have been around for quite a while. So let's kind of dive into how they work and that kind of thing. So they are a mortgage company. So when you work through NACA and they approve you for a mortgage, they're going to be the one to finance the mortgage. And they do have a few stipulations because it's such a great program. They offer a 15-year and 30-year mortgage. By the way, I didn't even introduce myself. My name is Sandy. I am a realtor here in Central Florida, licensed. We have this meeting every week at 7 p.m. and I always like to bring value to the meeting because I have so many people who are trying to buy homes, and because of various reasons they can't purchase. So my goal is always to try to find programs so that we could get more and more people in homes. And I contacted NACA and they were certified in Florida, and I was very, very happy about that. So how does NACA works? They require no down payment, no closing costs. You get below market fixed rate on your interest rate. There's no PMI, no perfect credit required, no consideration of credit score. And they also offer renovation and repair options, which means if you're buying a home from them and you need to, the property need repairs, they will allow the repair as long as the repairs are done before you close on the property, right? So they will do that, which I think is an awesome thing for them to offer. So that's kind of what it is. And believe you me, everything you're seeing here is the truth. There's no down payment, there's no closing costs. You get below rate fixed rate. You could have a mortgage funded by NACA for as low as 0.25%, and that's no joke. And what happened is they allow you to buy your points down. Each point is 1% of your mortgage. So you could buy your points down. The seller could help you buy your points down. And there's also grants that they offer that could also allow you to buy your points down. Okay. So the lender pays all your closing costs. The lender pays your appraisal, your attorney if you're using one, and settlement fees. Title insurance, transfer tax, buyer closing costs, all your closing costs. You pay no application fee, you pay no origination fee, you pay no underwriting fee, no document fee, none of the fees that is normally associated with a closing cost. That's all paid by them. Okay, so none of these fees will be paid. That's why there's no closing cost. Now let's talk a little bit about the mortgage option. They offer a 15-year mortgage or a 30-year mortgage. It's going to be a lot of information that I'm going to be going over. So if you guys have any questions, you could put it in the chat box and I'll try to answer them. I am going to try to answer as much questions as possible at the end. So they offer a 15-year mortgage and a 30-year mortgage. For every 1% of the loan amount, you could reduce your interest rate by 0.5%. So that means, let's say you're buying a home for $100,000, for example, right? And you have a 4%, let's say your interest rate was at 4%, you could buy 1% of the loan down by buying down a half of point. So that means 1% of the loan would be $100,000, 1% is $1,000, right? So for every $1,000 you buy the loan down, the interest rate goes down by 0.5 point. So if you put $1,000, instead of having a 4% interest rate, you'd have a 4.5% interest rate, right? And if you wanted to buy, if you put $2,000, then you'd have 1% down. Now, you're only allowed to buy 5% of the mortgage rate down. So which means if you're buying this property for $100,000, you could put $5,000 down, and you could put $5,000 towards it, and that would be 5 times 0.5, so you could buy it down by 2.5%, right? So if you're buying a home for $100,000 and you had no down payment, no closing costs, then you could buy it down by 5%. 5% would be 5% of the $100,000, which would be $5,000. Okay, so that's how that would work. The seller can also contribute to you buying down your interest rate. So because you're not paying no down payment and you have no closing costs, whatever money you have could go towards buying down your points. So again, on the first point, if you bought it down by 5%, your interest rate, instead of being 4%, will come down by 2.5%. The seller can also contribute to buying down your rate. So the seller could contribute up to 10%. Now, we know that most sellers will not contribute 10%. They will most likely contribute maybe 3%. But if they were to contribute 3%, you'll still get your rate even lowered even more. And look at this. There's no limit for the interest rate buy down with the use of grants or other nonprofit funds. So you could have a low interest rate, which is as low as 0.125. And here's how you get there. If you contributed 5%, you get down to 2.5, right? If the seller gave you 3%, then that's another 1.5 gone. And so you'd have a 0.50 interest rate at that point if the interest rate was at 4%. And if you got a grant to bring it even lower down to 0.125. Now, have you ever heard of a mortgage loan with an interest rate of 0.125%? Can you imagine how low your payments would be with that kind of interest rate? That is like insane, right? So that's why NACA works so well. Now, if you have a 30-year mortgage, each 1% would be reduced by 0.25%. So if you had a 15-year mortgage, it's going down by 0.50%. If you had a 30-year mortgage, it's by 0.25. Let's talk about 0.25 for a minute, because most people are going to go with the 30-year mortgage, right? So if you had a 30-year mortgage, for every 1%, so we're using the example of this house being for $100,000, right? So 1% of $100 is $1,000. So if you contributed 5%, which is $5,000, if you wanted to do that, and if you had the money to do it, you'd reduce it by a quarter. So it would be 1.25 that you'd reduce it by if you went 5%, right? I hope I'm not confusing anybody. So that would mean that you would have 2.75% left. If you ask the seller to buy it down by 3%, they could go up to 10%, but if they ask the seller and they went 3 to 5%, you'd still reduce it down more. So the only money you'd need, you don't have to have this money, by the way. You could just have the seller contribute to it, or you could have a grant that would contribute to it. And when you speak to your mortgage counselor, they would tell you the best way to go. So you don't have to, you could buy it down by 5%, you don't have to do that. The seller could buy it down by 10%. We normally try to negotiate with the seller to buy down your points as much as possible, because the lower your interest rate is, the lower your mortgage payment is going to be. And when NACA approve you, they're going to approve you for what monthly payment you can have. So the monthly payment that they approve you for is going to include your HOA, your insurance, your taxes, everything, right? So one of the ways of making sure we stay within this monthly payment is by reducing the interest rate. And again, we could ask the seller to reduce the interest rate. You could reduce the interest rate by paying some money as well, or we could get a grant, okay? And the mortgage counselor would go through that. So I hope that makes some sense. Now, feel free to text and email me any questions after this meeting, because I know you're going to have a lot of questions. So just feel free to do that. Now, here are the interest limits. Here are the limits, the mortgage limits that they'll allow you to get. Your purchase price plus any repair cannot be over $484,000 for a single family home in most areas, or $726,525 in high cost areas where where the cost of living is considered to be high. Now, NACA have their own map, and they determine based upon the area that you're looking to live in, they will determine if you're at the 484 or if you're at the 726. Now, for most people, they're going to be at the 484, and that's quite a bit of money, right? So this means you could go out and get a home and still get money to fix it if it needs fixing and still stay under that 484. Now, I don't know if you want to go as high as 484, but you go as high as that based upon the area you live in. Some areas you got to go there, like some areas of New York, you know, you'd have to go there to get that kind of rate. All right, let's move on. So we have priority members and we have non-priority members. Now, what's the difference between priority members and non-priority members? Priority members are low to moderate income members, okay, borrowers and co-borrowers and other household income earners, whose combined income is less than the median family income for the MSA they are purchasing the home in. So that means based upon the area you're purchasing the home in, they're going to determine what's the median earning. Okay, so based upon the area you're buying the property, they determine what that median price is, and that is how they determine what your purchase power would be. So that's low to moderate income. Priority members can purchase any property within an MSA with a purchase price not exceeding the 2019 conforming loan limit. So we just went over the loan limit of 484 or 726, I think it was. We go over that. So I'm trying to figure out who is not muted, because I know it's not my background noise. And the non-priority member is going to be based upon your income. The priority members are going to be low to moderate income members. And that's because NACA is more focused on those kind of income earners, because they're the hardest ones to get a mortgage. So they're going to give those priority. And that means that they're going to determine the median income for the area you're trying to purchase in. And if you're below the median income, then you become a priority member. If you're above the median income, you become a non-priority member, and you could still purchase if you're a non-priority member, but they are a little bit stricter on that, and they'll give you a certain section, census tract, where you could purchase. And in most areas, most people do qualify anyway. So unless you're like earning a lot of money, it's the only way you would not be able to go there. So they have a map where they determine what the priority areas are. It's a census tract, and it depends upon how many people are living in that area and what the median income is. And that's something that once you decide to join the program, they will go over with you. This one is actually based in Atlanta, because in Newark, New Jersey. This is a census tract that they did in New Jersey, and they determined that the median income for that area was $98,000 a year, and that the tract median family was $40,000. So that's why they kind of go by that, and your counselor would go over that with you, because that becomes very technical, and we don't want to listen to that right now. So NACA is funded by Bank of America. Now let's look at what it takes to get a mortgage through NACA. So you have to be the first-time home buyer is not required, but you cannot have any other mortgage in your name at the time of closing. That's why it says you cannot own other properties at NACA closing. You have to occupy the property. You got to be owner occupancy. You have to volunteer. Once you go to NACA program, they have different events that they do, and you have to volunteer at least 5 times a year, which is not a big deal. You got to be a registered voter. Now, the $25,000 security agreement, what they do is once you close on the home, they're going to put a $25,000 lien on the property. And here's why they do that. If they find out that you're not an owner occupied, that you're not occupying the property, that you bought the property as an investment and you're renting it, they're going to charge you $25,000. So they're very serious about that. They really only want homeowners who are going to occupy the property. So if you know you're buying the home and you're not going to occupy the property, do not come through this program, because they have many ways of finding out, many ways. and people are fined this $25,000. And either you have to pay them the 25,000 or they'll put a lien on the property. And when you sell the property, guess what? You have to pay them $25,000. So don't even try it if you're not going to occupy the property, right? You have to agree to NACA program guidelines, which they go over with you once you join the program. And there's a home buyer workbook that tells you all about the NACA eligibility, which you get once you sign up for the program. Now here's the payment that they look for. 24 months of on-time payment history. So they want you to see that you're in a job for 2 years. They're going to, are the same job for 2 years or the similar trade for 2 years. You can't have no open judgment or liens on your credit, which means within the last 2 years, you can't have any open judgment or lien. No foreclosure, short sale, or bankruptcy within the last 2 years. You're going to look for 12 months of on-time rent payment. Budget payment shock savings. That's something that they put you on once you start the program. And they also have a minimum required fund. Now, the minimum required fund, they're going to look for you to have some kind of money in the bank, but it's going to be somewhere between, I think, $2,000 or $3,000. However, it's based upon income. So once you speak to your mortgage counselor, they will tell you what minimum required income you need to have in the bank, right? And remember that you're not doing no down payment, you're not doing any closing costs. They just want to see that you have some money left so that when you close on the property, you have a monthly payment, that you have the next 2 or 3 months of mortgage payment in the bank. That's exactly what they're going to be looking for. So if they approve you for $1,500 a month, they're going to want to see that you have $4,500 saved in the bank, as they call it, reserved funds. And any bank is going to ask that. So that's not something that you're asking for that's like terrible, okay? So the biggest thing on this that I'm going to point out is that make sure that you're buying the property to be owner occupied and you don't intend to rent it out and not to live there, because they will put a $25,000 fine on it, okay? So you can't have any other property in your name. You don't have to be a first-time home buyer. You could have bought a property before, but as long as that property is no longer in your name or you sold it, they'll be fine. If you have a house that you're selling to buy a NACA home, that's fine, as long as that property closed before you close on the property that you're buying through NACA, okay? And again, NACA means Neighborhood Assistance Corporation of America. That's what it stands for. So let's talk about the steps to home ownership if you're going to go through this program. The first thing they're going to want you to do is to attend the entire 4-hour workshop to receive credit. The reason why they say entire is because this 4-hour workshop is virtual. So it's gonna be coming, you're going to be doing it online. And they know that some people will put the computer on and go do different things and not listen to the program. So they have a way of knowing if you did the 4 hours or not, right? So you have to complete the 4-hour online thing. You have to attend, they're gonna have you confirm at the end of the workshop that you did attend it. You provide the name of your choice of real estate agent. So obviously I'm a real estate agent, so you better all choose me. But anyways, you could choose a real estate agent you want to work with. And they also give you a ID number, right? So once you get that 4-hour workshop done, they give you an ID number, and after that time, you'll use your ID number every time you log into the website. House counseling and ownership preparation. So here's what that takes. You're going to have an appointment with the mortgage counselor. It's going to be phone or face-to-face appointment. All the documents that you're going to need, they're going to have you upload. I'm pretty sure it's not going to be a face-to-face appointment now because of the COVID, right? So everything is going to be virtual. So you're going to upload all the required documents that they're going to need through their web file. They're going to review your payment history, and that's the biggest thing, is going to be your payment history. They're going to also review how stable your income is. So let's say you have to change jobs. Let's say you were on your job and you had to change jobs. You changed jobs a month ago, 2 months ago, a year ago, whatever, you change jobs. They're going to look at the job that you have, and they will determine if they will use that. So if you have not been on the same job for 2 years, that's not a problem. As long as you could determine that the income is stable and that you're going to be employed for a period of time, then that's fine, right? The housing counselor will then determine what your mortgage payment will be based upon the payment history and your income and all that great stuff. And if you have to take any action steps, then they will determine what action steps you need to take. So there's no such thing as not qualifying for this program, right? The only thing is, are you going to qualify now, or you might need 2, 3, 4 months to qualify, because they might need you to do a few things to qualify, right? Maybe you might just have started a new job and they want to see that you're on that job for 3 months. So that will delay you by 3 months, right? So there's different reasons why they'll do that. Or maybe you just start renting 6 months ago and you want to get a jump start. So they will still accept you in the program, but they're going to allow you to continue out until you have 12 months receipts. So you don't have to literally wait until you have 12 months of rental payment, but they're going to want you to do that. So I always tell people to start the program as soon as possible, because whatever issues you have, we will know upfront and you could take care of it and make the process smoothly. Now, if you're ready to go, let's say you join the program and they say that, okay, yes, you're ready to go. It takes 30 to 45 days to close on the property once you find the property, right? If you need work, they will give you an action plan, an action step, and tell you what exactly you need to do to qualify for the program, right? So there's no such thing as I didn't qualify. So they do have workshops, and some of these things have changed because of COVID. I know that they don't have their local offices open anymore. So the every Thursday at local offices meeting is now done online. It's no longer face to face. They do give you a financial letter, a qualification financial letter. You are provided hey, look at this, I forgot. Listen, you don't even pay for your inspection. They pay for your inspections and any work that you need done, because that's going to be a part of the loan, right? So you don't need to worry about paying for your home inspection. They'll do that. They'll also provide you with house searching tips. They will teach you they will give you a step-by-step from contract to close timeline, what that will take. And if you're a real estate agent, you can't be in the workshop. Nobody's a real estate agent. So anyway, this every Thursday at local office thing is now done online because of COVID. All right. So they give you a qualification letter. This is kind of what that qualification letter would look like. They're gonna have your credit, income, asset. Your underwriter is going to be determining your income, your asset, your credit. They're going to determine if the property that you're purchasing has HOA fees, what kind of renovation it might need, and the maximum amount that you can go. So everything is based upon your monthly payment. And again, remember that the monthly payment includes your principal, interest, taxes, and insurance, guys. There's no PMI, but if they tell that, okay, you could go up to $2,000 per month, you don't have to go up to $2,000 per month. But if that's what they tell you, you cannot go to 2001. You could stay below, but you can't go over what they tell you. They also will give you your estimated loan amount. The pre-qualification letter expires in 6 months, both for priority and non-priority members. And they don't want you to show the agents your qualification letter, right? So what you got to tell the agent, though, is what you're qualified for and what your monthly payment is, because the agent is going to have to work to get you that amount. But you don't have to. The reason why they don't want you to show this letter to the agent is because your credit and your income and your asset will be on it, and they don't want you sharing that information. That's your private information. The only thing the agent needs to know is the amount you're qualified for and what monthly payment we can't go above. Because remember, one of the ways of getting the monthly payment down is to get the seller, is to get a combination of some money from you, some money from the seller, and also some grants to pay down the interest rate to get it down from wherever it is. So the lowest you could go is 0.125%, and that's where we want to get it, right? That's where we want to get it as low as possible, because the lowest you get the interest rate, the cheaper the loan is going to be. So that's the good thing. So here we see, in order for you to maintain your qualification, so remember the qualification lasts for 6 months, right? So they're going to be checking to make sure you're doing all this stuff, in the next 6 months. So let's say if you got qualified today and you didn't buy until 4 months from today, they're going to be looking to make sure that what you told them in the beginning is still the truth. So they're going to make sure that you're paying all your payments on time, that your income did not decrease, that you did not increase your debt. That means if you're qualified, guys, you can't go out and take out any credit card. You can't buy no cars. Don't go to, what's the name of the furniture store again? Oh my God. Don't go to, is it Room Plus? Rooms to Go. Don't go to Rooms to Go and take out a credit card at Rooms to Go to get furniture. When you're in the process of buying a home, don't take on any new credit whatsoever. Don't don't take on any new credit from Home Depot, Lowe's, any furniture store, any credit, anything. Don't buy no car, don't do nothing, because they're going to be checking this, right? And they don't want to see any increased debt. They don't care if your credit score went down, but they don't want to see that you got more debt than what you told them you had initially, right? If they wanted you to do a payment shock saving, you have to continue to do so. The payment shock saving is something they have you save. So let's say they approve you, but you didn't have enough money. You didn't have that 3 months money saved in the bank. They're going to put you on a saving program based upon your income and all that great stuff to show you how to save to get to that point. So if you're on the saving shock,
Yeah, I see it.
then you cannot. They want to see that continues to go. Okay. And then they're going to also go by the property taxes, homeowners insurance, HOA fees if they apply. So all this stuff right here is what they're telling you they're going to be looking at to determine your monthly payment. The property tax, the homeowners insurance, your HOA, all that great stuff. All right. So let's go to your house search now. So what kind of homes are eligible for this program? Any home is eligible. It could be an existing property. It could be a new construction. It could be a short sale as long as the short sale is approved. It could be a foreclosure as long as the bank that's selling that foreclosure property is okay with you as a knocker buyer. Now, I'll tell you this, if you're buying a foreclosure, it's going to be very difficult to get that bank that's selling that foreclosure to help you to buy your points down. The most you're going to get from them is probably 3%. Most foreclosure bank will give a 3% concession, which you could use towards buying down your points. It's going to be kind of hard to get more than that from them, but each bank is different, right? If it's an existing property, then we will talk with the homeowner and try to get them to give you as much as possible. Some of them might give you 3%. I've had homeowners give as much as 6% buy down your points, right? So that's good. New construction, the builder, since most builders pay some of your closing costs if you use their lender, you will not be using their lender, you're going to be using NACA, right? Bank of America. So depend upon the builder, a lot of new construction will work with you, some won't. So it's going to be a case by case. But the builder is going to have to be able to work with you and be willing to buy down some of your points, which of course some of them will because they don't have to pay your closing costs. And this is a non-for-profit organization. So some of them will be more than willing to do it. I know Starlight Homes, which is a new construction builder that we work with a lot. They will help you buy down your points. I know for sure they'll do that. Now, if it's a short sale, we want to make sure that the short sale is approved. The thing is with short sales, you might be able to get 3% buy down from them because remember that in a short sale means that the property owner is selling the property for less money than what they owe their mortgage bank. So let's say the property owner had a property that they bought for $100,000, but they bought the property for $100,000, but now they're selling it for $70,000. So it's no longer $100,000. So they're going to sell the property for $70,000, which means they're going to still owe their mortgage bank $30,000, right? So their mortgage bank has to agree to take that loss, and that's called an approval process. So once the mortgage bank say, yes, that's fine, you could go ahead and sell your property for $70,000, then they could sell the property to you. Now, because the bank is taking a loss of $30,000 in this example, they don't want to give no money out, right? They don't want to really, because they're already losing so much money. So a lot of banks that do short sales don't like to help the home buyer out at all, because in their opinion, you're getting their $100,000 property for $70,000. Why should they help you any further, right? So some of them are willing to give up to 3%. So if that's the case, then you would use that 3% to buy down your points. I'm going to take a glass of drink. So then you'd use that 3% to pay down your points. So short sale and foreclosure, that's probably the most we'll get from them. New construction, no, some builders are very nice, and some builders might give you even up to 7-8% to buy your points done. Because remember, the more we buy down your interest rate, the lower your monthly payment will be. And remember, for a 15-year mortgage, for every 1% that we give, the mortgage rate decreased by half a point for the 15-year loan, and for the 30-year loan, for every 1%, the mortgage rate decreased by 0.25, right? So the most money we could get from the sellers and from grants, the better for us, because we might end up with an interest rate of like 0.50%, which is what makes your payment so much more better, right? And nobody has that kind of interest rate. Interest rates are low now. They're like what, 4%, maybe 3.5%, but nobody have 0.50% interest rate or 1% interest rate. But you could get that through NACA. And that's one of the reasons why they're so strict, that you have to be owner occupied if you're going to be using this program. You cannot not be owner occupied. And if they find out you're not owner occupied, they're going to charge you $25,000. And that's the lien they put on the property. Now, if you're owner occupied and you're selling the property, of course, they'll take the lien off, and that has nothing to do with you. So that would be fine. All right. So we could buy any home. The determining factor is going to be how flexible we're going to get the seller to work with us, right? So the more flexible the seller is, the better for us. All right. Okay, let's see now. So what properties are we could use in this program? So we could do a single family home or a townhome. Unfortunately, a lot of the condos are not accepted because they have different criteria with the condos. Deshaun, I know you just joined us and I'm trying to mute you and it's not working. Can you mute yourself for me, honey? For some reason I can't mute you from my end. All right, so condos, if it's a condo that you're buying or a co-op, it's going to be a lot more guidelines, right? With the condo, the more than, I think let me think about this. If it's a condo, 90% of that condo have to be owner occupied. And most of the time that's not the case, right? Because a lot of people buy condos and rent them out. So if you're buying the condo development, 90% of the condos has to be owner occupied, which is the bad part about that. So it's best to stick to single family homes and townhomes. That we have more priority in. So properties that are ready for members to move into immediately after closing. So each property that you buy through NACA, it has to be in move-in condition. So that means if you found a property and the property needed work, we have to get the work done before NACA will allow you to close. Now, of course, you could go ahead, they'll do the work, they'll fund the money for you to do the work, and that's going to be a part of your loan. So again, I know I keep using this example of $100,000 and it doesn't exist, does it? I don't even think so. Anyway, if you're buying this $100,000 property, you needed $10,000 worth of work before you move in there, then your loan will become $110,000, and they will give you the $10,000 to fix it before you move in. Or you can't close on the property before it's fixed either, right? So the repairs have to be made, and they have to go in, and the inspector got to go in and make sure the repairs are done, and they're done up to code, and they're done by licensed people, and then they'll allow you to close. All right. Do not need any repairs or have all required repairs completed by the seller prior to closing. So if the seller, okay, let's say you're buying a property and there's some repairs needed, and the seller said, okay, I'll do the repairs. Those repairs have to be done before you close, and the seller and the inspector got to go back to the property and make sure the repairs are done correctly before you could close. That's very important, right? Remember that you have to factor in the HOA fees into your maximum approved monthly payment. So if they approve you for $2,000 a month, then remember that we have mortgage, we have taxes, insurance. The HOA has to be a part of that as well. So that $2,000 have to include all the property expenses, which is going to be the mortgage, the insurance, the taxes, and also the HOA, right? Everything got to come under $2,000 because they're going based upon your income, and they're also looking at what you're currently paying for rent as well. Okay, they're taking all that into consideration. All right. Now you can finance for property rehabilitation, but the property rehabilitation, as I said before, has to be done before you move in. So, which means you could buy a property, you could buy a foreclosed property that needs work, but we have to do the work before they allow you to close, okay? Because they want to make sure that there's no, you can't tell them, well, I was supposed to do the work, but then it wasn't done, and you know, that story, you can't do that. They will not allow that to happen. So that's why all this has to happen before they'll allow you to close. So, wait a minute, I think I went too far. Here we go, condos or co-ops. Oh, I'm sorry, it was 50%. Okay, so I was wrong with that. So you got to make sure if you're buying a condo or a co-op that the HOA is included in the maximum approved monthly payment. NACA has to get a copy of the condo questionnaire and their master insurance policy and the HOA budget. So that means each condo is going to have a master insurance policy, they're going to have a budget, and they're going to have what is called a condo questionnaire, which you have to fill out. That has to be reported to NACA. It has to be 50% owner occupied. They cannot be, oh, this is where I made a mistake. So you know how people don't always pay their HOA fees? So what this means is HOA delinquency cannot exceed 10%, which means if the condo has 100 members, only 10% of those members is allowed to be behind on their HOA fees, right? 90% of the owners have to be paying their HOA fees on time, okay? And the purchase contract contingent on HOA, okay. So if you're gonna buy a condo or co-op, this last thing that says purchase contract contingent on HOA approval, it means that NACA has got to approve that HOA board if it's a condo or co-op for you to qualify. So that means that if you put an offer in and NACA got all the information and they realize that there's more than 10% HOA delinquency, then they will not allow you to close on that property, right? And that's a very low rate, because I promise you that most of the time it's 20 to 30% delinquency that most condos and co-ops have. So 10%, I don't know. I guess it would depend upon how big the condo or co-op is. And that's like a very marginal thing. So these are some of the things. If you're looking to buy a condo or co-op, these are some of the things you want your agents, me of course, to find out before you go into contract. You want to find out what the delinquency rate is, and you normally find that out through the HOA board, and that's something your real estate agent is easily able to find out for you. Okay, because if you call the board, they're not gonna tell you that. That's private information to them. But if a real estate agent call, sometimes they will give it. Sometimes we have to order a report that you have to pay for. It's called an escrow letter. And in that letter, it will tell you what the delinquencies are. So that's the thing with condos or co-ops. Now, I know we're in Florida. In New York, they have more 2 to 4 unit multifamily. Florida don't have a lot of it, but you could still buy a 2 to 4 family unit from NACA, because that's still considered to be residential. Up to 4 units is residential. So for this, you got to be the primary resident. You have to live in one of the units. An owner's unit, so you have to live in one of the units. So one of the unit must be vacant before you close on the property. They must know that you're going to be living in if you're going to buy a 2 to 4 unit. The contract must specify which unit will be empty. So, they're very strict with this. So if you're buying a 4 family and you're going to live in apartment 1, the contract must say at closing, owner is going to occupy apartment 1. 75% of the rent is used as income. So that means, which is a good thing, because what they're trying to say here is that most of the money you get from the property, you're going to use to pay your mortgage and your HOA fees and that kind of thing. So that's awesome. If you're going to buy a 2 to 4 family, you have to have 3 to 6 months reserves in the bank. And you have to take their landlord tenant training course. And copies of the lease for all current tenants must be supplied to them. And you have to have a minimum of $400 per month surplus. So let me break that down for you. If you're buying a 2 to 4 unit family, I'm not going to spend a lot of time on this because I know this doesn't exist a lot here in Florida, but I also do New York. So just in case I have any New Yorkers on the call, 2 to 4 families, if you're going to buy it, you have to live in the property. You have to tell them what unit you're going to live in, right? 75% of the money you're going to collect from that property has got to go back to paying your mortgage, which is great because that will help you to qualify even better, right? You have to show NACA that you have 3 to 6 months of reserves in the bank before you close. So if you're buying a 2 to 4 family and it's $1,500 per month, you have to have $4,500 to $6,000 in the bank. Wait a minute. To $9,000, $4,500 to $9,000 in the bank as reserve. And plus you got to have $400 more per month surplus, which means you have to have the $4,500 to the $9,000. And then 400 times 3 is 12. Then you have to have $1,200 to $2,400 for surplus, right? That's what you have to qualify for if you wanted to buy a 2 to 4 family unit. Okay, what about a commercial mixed use? A mixed use property is going to be a property where they have a business on the top, a business on the bottom, and residential on top, right? Or something like that. So they're saying that if you're going to do a commercial mixed use, 50% of the property must be used for residential. So it could be a side by side where there's an office building on one side and there's a home on the other side, or there's an apartment downstairs and the business is upstairs. That's what that means, right? Members doesn't have to be owner of the business. So you could buy a mixed-use home. You don't have to own the business, but you have to live in the property. That's the only thing. So if you had a mixed-use property where there was a business downstairs and there's a home upstairs, you could rent the business out downstairs and you could live upstairs. 75% of the rent is used as income for space currently with tenants. So that means if you rent out the space downstairs, the commercial part of it, 75% of the money you're collecting has to go back towards your mortgage payment. Appraisal value of property must be primary residential. So when the appraiser goes out there to appraise the property, he has to appraise it based more upon residential as opposed to commercial. And I guess that's why they want the 50% residential. And it has to meet zoning requirements. So it means that if you're going to buy a mixed-use property and you have, say, a hair salon on the ground floor and you live upstairs, the hair salon has to be zoned to be there. So the building coordinates of that area has to be zoned so that it is zoned for commercial. Hi, Charles. I know you just joined. Could you mute yourself for me, honey? Just go ahead and mute yourself because I'm unable to mute you. I don't know why I can't mute people as they join in. I'm so sorry. Let's talk about flood zones requirement. That's a big thing in Florida, right? NACA reserves the right to reject properties located in flood zones. Now, flood zones are a big deal, and a lot of times the flood zone changes, right? So maybe at one point in time, one area was not a flood zone, and all of a sudden it then became a flood zone. So we want to definitely make sure that we're checking. Your agent has to check the flood zone in the area you're looking to buy. And if you're buying a flood zone, we have to disclose that to NACA so they could determine if they're gonna what they're gonna do. And if you're gonna buy in a flood zone, you have to have flood insurance, and the flood insurance is going to be included with maximum approved monthly payment. So this is going to be a no-brainer where we know we're not going to buy in a flood zone because flood zone insurance are very expensive, and I know that for a fact. Your monthly payment is not going to be able to cover flood insurance. So we will just not, I would say just stay away from flood, any home in a flood zone property. Okay, so here we go. We're going to do this last part. So once you're approved, I'm just going to give you a little snippet of this and then we're going to move from here. Once you're approved, we're going to create a contract for you. Your agent will create a contract for you and submit to NACA. They're going to ask for a bunch of different information, either from you or from your real estate agent, which would be me. So once we submit the contract to them, they're going to determine if they approve the contract or not. Some of the things they're going to look for are some of the stuff that we just discussed. Is it in a flood zone? Is it a mixed-use property? You know, that kind of stuff. Is it a condo? Is it more than 10% delinquency in this condo? So that's some of the stuff that they're going to want to determine once we send the contract into them. Also, your agent is going to have to give them comparables in the area because they're going to want to make sure to know. They want to also make sure that the property that you're buying, even though they're going to also do an appraisal, but they want to make sure that the property that you're buying is gonna appraise for the purchase price, or somebody's not trying to sell you something that's over the top kind of property, right? So this is kind of where we're going to leave off with this. That is a good overview of how the NACA program works. Where's my video? Hold on a second. Yeah, I don't want to do that. So that's kind of how the program works. You could now go ahead and let me know if you have any questions right now. What I'm going to do, there's quite a bunch of us on this call. So what I'm going to ask you to do, I am going to ask you to send me any questions that you have. If I'm not able to answer your questions right now, I will email you the answer or text you. So what I'm going to discuss now is, what do you do if you're ready to buy? Let's say you're okay and you love the program. What do you do? The next step would be for you to let me know if you want to do this or not. If you want to do it, just send me an email or a text and let me know, hey, I'm very happy about this program. What do I do next? I'm going to give you a call and I'm going to go over everything with you again to make sure that we're on the same page so you know what you're getting yourself involved with. Okay. Once we do that, I will send over your information to NACA, and all you have to do is sign a form to say that you you agree to their terms and that you want to become a NACA home buyer, I'll send you that form. You'll sign that form and we upload it in their system. Once that's done, your next step is going to be to take the 4-hour training online course that they offer. Once you take that course, they will assign you a mortgage counselor. When you're assigned a mortgage counselor, that's when the mortgage counselor will give you a PIN and a username and password to log into their system. And you're going to upload all the information that they're going to want you to have, right? You'll upload all that information to them. And at that point, the mortgage counselor would then tell you if you qualify or not, and also will tell you if you need to work on anything, right? If you need any homework to be done, like if they want you to fix anything, they'll let you know that. And they'll also give you a time frame of how long you have to fix it. Once that's done, they'll then give you a pre-qualification certificate. Once you get the pre-qualification certificate, that's when you know you could start looking at homes, okay? Once you start looking at homes, then you find your home, then that's when we're gonna have to start working with your monthly payment, how much you're approved for, and how many points we need to buy down to keep you under your monthly payment. So don't be worried too much about the monthly payment because that can be adjusted based upon how much money we could find for you to buy down your interest rate. So again, that money could come from you. Some of that money could come from you. Some is going to come from the seller, and some could also come from a grant. And your mortgage counselor will also give you a list of grants if you need grants as well. They'll also tell you how much money you'll need to have in the bank to close. If you don't have enough money to close, they'll put you on that savings program where they help you to save. So every step of the way, they're holding your hand. Remember that this is a non-for-profit organization and they're being funded by Bank of America. So they don't really, they don't need to close on their home, they don't need to close on your home for them to make money, if that makes sense. So people are still joining, believe it or not. We're always at the end of, I'm almost over time. So they don't need, they're not looking for like, oh, we got to do all these mortgages, right? They want to make sure that you're in the best time possible. So they're going to guide you every step of the way and make sure that everything that you're doing is what you should be doing. And they're going to help you to save if you need to save to get that money you need for you to close on the property. So it's so much different things that is a part of this, right? But that doesn't mean that you still shouldn't take care of your credit, because remember, guys, credit is everything, right? And after you close on this beautiful home, you might need to buy some furniture and all these different things, and you want to make sure that you're saving for that. Wendell, are you on the call, Wendell? Are you on the Financial Fitness Evolution group? Is that you, Wendell?
Yes, I am. Sandy, how are you?
All right. Hey, so Wendell is our credit repair guy. Hey, Wendell.
How are you?
I am good. Lots of information here today. Lots.
Quite a bit. That's good though. Good stuff.
Yes, it is. I almost finished the whole hour just by talking about that. So Wendell is going to just do a little snapshot of, you could also go ahead and improve your credit. He's going to just give you a little workshop, a little thing on that, because credit is king. Even though you don't need a lot of credit to do NACA, but you definitely need credit to do other things. So Wendell, you could take it away. Let me unshare my screen. Oh, I did. Okay, Wendell, it's all you.
All right, let me see if I can share mine. Well, great overview. That was a lot of great information, and it's interesting how some of the things that you're sharing, our services can certainly help your clients get on track towards being able to become a NACA client in many ways, and such relevant information in terms of, when you buy that home, you're going to want to furnish it. And 90% of the time, if you go out to buy some furniture, most people don't have that cash on hand to do it, so they're going to have to finance it as well. So very relevant information. So let's get right into how we can complement and work with your customers that are in need of a minimum good credit score to move forward. So United Credit Education Services is who we work with. Let's see if my screen will keep moving. Give me a second here. There we go. So founded in 2004, they are headquartered in Falmouth Hills, Michigan, a unique collection of services carefully selected to provide financial protection and opportunity. Complete debt-free company that has helped thousands of people. So our company's been around for so long that we've helped tens of thousands of customers. And it's the same owner since the company's inception. So why is this more important than ever? Well, you just kind of went over that, right? People are trying to buy homes, trying to buy car, refinance, and so it's very relevant. In fact, the single biggest difference between financial success and financial failure is how well you manage your money. It's simple. To master your money, you must manage your money. And so even with going through the NACA program, you notice there's a lot of money management things being talked about there, and they're going to help you with that. And we've got some services that will do the same thing. So 5 shocking facts you didn't know about your finances. 1.057 trillion Americans are in credit card debt as of March 2019. That is a staggering number. 56% of people in the US have no rainy day funds. What does that mean? Well, you kind of heard Sandy talk about money in the bank, right? Because at the end of the day, you're trying to buy a home. Doesn't matter how inexpensive or easy it is to access it. Guess what they want to see? They want to see some cash on hand, and we call that rainy day funds. And so this is a staggering figure. 46% of baby boomers have less than 10,000 saved up for retirement. That's a big number, right? 40% of millennials have spent money they didn't have to keep up with friends, and most kept it a secret. It's so easy to try to keep up with the Joneses through social media right now, right? People buy what they can't afford, and all of a sudden they're drowning in debt. How about this one? 43 million Americans have a credit score of 599 or less. So this may not be a factor for a NACA home, but if you don't, well, Sandy said you will qualify over time, and maybe having that great credit score will get you where you need to be so that you do qualify. So here's what poor credit does to people. It gives you anxiety, embarrassment, frustration, fear, and confusion. But listen, it's nothing to be ashamed of, because negative credit happens to a lot of great people, right? It doesn't discriminate. It doesn't care about your background, your origin. You can go from being a great credit score person, being responsible your whole life, and all of a sudden you've got one medical incident, and boom, it sets you back, and you've got less than perfect credit. But here's the opposite of having bad credit. When you have excellent credit, you get a feeling of confidence, excitement, and abundance. Why? Because you can access things with a strong credit score. And here's some of those things. So ultimately, a good score opens up possibilities to create lifestyle you desire. So things like new houses, unfortunately, you can't have more than one home if you're buying a NACA home, right? New cars, low interest rates on credit cards and loans, higher limits, contracts without security deposits. That's the beautiful thing about having a great credit score. So United Credit Education Services, we are helping individuals and families build, organize, and protect their financial future. One award-winning protection plan with 12 life-changing products. So we're going to run through these, and I'll cover them in more detail with you. Budgeting, credit restoration, credit builder. So think about it. That budgeting piece, NACA, right? Credit restoration, NACA. Credit builder, credit attorney, credit monitoring, debt payoff, again, NACA. Financial lockbox, identity monitoring, net worth, savings goal, will trust, and the youth financial literacy. So here's the build of your financial portfolio. First and foremost, we can leverage the Fair Credit Reporting Act that was passed in 1970 by Congress to challenge anything that negatively affects your credit scores. So we're going to build your credit score with also our credit builder and the dispute process. Credit monitoring, you can actually track your progress on a consistent basis, watch your growth, see how you're using your credit card and or credit cards, and see your 4 credit scores that you have as a consumer, your FICO score, your higher index, your insurance score, as well as your mortgage score. So it's all there. And then credit attorney will get involved with any kind of negative things like debt harassment or something that really shouldn't be there. They will actually sue the bureau, and in some cases you may be entitled to a compensation. So you're saying, well, this is great, we're building, but how do I understand what makes up my FICO score? Well, here are 5 factors. First and foremost is payment history. That is 35% of how your score is determined. So if you're not paying your bills on time, NACA won't even take a chance on you, right? So you've got to you got to pay your bills on time. I mean, remember she said earlier, they want to see 12 months of on-time rental payment history. That's important. Capacity amount, that's how you're using your credit card. Credit cards are a great way to build credit, but you've got to use them responsibly. That means paying them on time and keeping them below 30% of the limit. The other 3% is 50% is length of credit. How long has that trade line been open? And 10% new inquiries, and another 10% types of credit, installment loans versus revolving loans. So if you want to take a picture of this, these are the 5 factors used to calculate your FICO score. But here's what's really great. Lenders typically don't use your lowest score or your highest score, right? So you're not judged on your best day or your worst day. You're judged on your average day, how well you do over the course of time. That's your middle score. That's your FICO score. Let's organize your financial future by creating a budget. So by having a budget, now you can go out and buy that furniture once you bought that home. Net worth, calculate your net worth by subtracting your liabilities from your assets, and that will tell you what you really are worth. So it's not just about celebrities and athletes. Guys, you have a net worth, right? Your Prada bag, your Gucci purse, that car that's paid off. Anything that you have that has value there's some net worth behind it. YFL I'll cover in a moment, because we actually give back to the youth, and we want to start there because why? When we grew up, we were not taught about financial literacy in schools. And so we want to make sure that we don't miss the youth in this era. And then debt payoff. You can create a financial plan that will give you a guide to pay off your debt, meaning plug in your credit card, your mortgage payment, your car note, plug it all into this database, and we'll give you a schedule of when to pay, who to pay, and how much to pay, and get you out of debt faster than you can even imagine. Protect. So we've got identity monitoring. You know, identity theft is very, very rampant today. And so this is a way that you can protect your identity from being stolen. Will and trust. Listen, when you own your home, you definitely don't want to just leave it up to blah, right? Something happens to you, who's going to make sure that your children gets that asset? You've got to have that ultra power of attorney in place. Financial lockbox give you a chance to roadmap your financial information in one central online location, and you can actually give that information to someone that you trust in case of an emergency. Savings goal, I love this because it allows you to create multiple goals and choose when you want to achieve those goals. And we also send you consistent reminders. On top of that, once you become one of our customers, we give you access to what we call Shop for Less. This is an exclusive UCES member program where we give on average 5.4% cash back on every purchase. So for example, I went to Lowe's today, and before I cashed out at Lowe's, I actually went on and bought a Lowe's gift card so I can get the cash back before I spent my money at Lowe's. Great service, right? So here's our roadmap. So once you become a customer, we're going to give you a guideline so that you can achieve the maximum result in a short period of time. Some folks are better than others, right? Like Sandy said earlier, it might take you 3 months to be ready for NACA, or it might take you 12 months. It doesn't matter. You can still be approved and qualified, but it might take you some time. So we give you a roadmap so that wherever you are, we can help you identify what your shortfalls are and make it better. But month number one is let's go ahead and start on activating your credit repair, and then activate your credit monitoring and set up your identity monitoring, right? Because we want to get those dispute letters to you out right away so that we can start challenging anything that's negatively affecting your scores. Remember, she said you can't have any liens and bankruptcy. And guess what? The Fair Credit Reporting Act lets you challenge everything. It doesn't matter what it is: student loans, bankruptcies, foreclosures, tax liens. And we've effectively removed those things from people's credit profile, which in turn improves your credit scores, which in turn gives you that access to that NACA fund, right? Number months 2 through 3, build your credit score. You want to apply for a secured card. Why? Because you want to add positive trade line, build that credit portfolio. Report your rent payments. And not only does NACA look at your rent payments, guess what? We look at it and we actually report it to the Bureau up to 24 months as another positive trade line. Number 3, utilize the credit builder tool to provide you with information on how to increase your credit score and tips to improve your results. So that's month 2 to 3. How about 4 through 6? Work on any outstanding debt. What does that mean? Activate our debt payoff system. Remember I said earlier, plug in all your debt in this debt payoff system, and it calculates who you should pay, when you should pay, and how much you should pay to get you out of debt. Track your income and spending by setting up your monthly budget and program as well. Month 7 through 9, you want to establish your family security. Why is that important? Well, you want to have that Realtor's power of attorney in place in case something happens to you when you own that home. The state and your loved ones know what you want your will to be. You don't want your stuff in probate because that's going to cost them money, and most often than not, nobody wins in probate. Number 2, protect and secure your financial documents in our financial lockbox vault, excuse me. And number 3, develop your savings goal and plan for future expenses, such as that the furniture you want for your home once you buy it. Okay, that's 7 through 9. How about 10 through 12? Now you're on track. Your credit score is great. So let's go back and talk to those insurance companies that maybe your Geico or your Allstate or your State Farm. Hey, listen, my score is improved. Can you look at my insurance premium and maybe give me a better rate because I have a better credit score? Calculate your net worth and enroll your children in the YFL, which I'm going to talk about shortly. So this is a roadmap. You can fall in anywhere in this where your demands are, but it's just to give you an idea so that you don't just jump into a program and have no one holding your hands throughout the process. On top of that, this time that we're in is all about what? Convenience. So we give you an app. So from the comfort of your cell phone, you can actually log on to your services and see where you are, activate your services, and then you notice here it says roadmap. So everything is at your fingertips. Now, what does it cost to take advantage of these 12 products that are phenomenal, get you out of debt, build your credit, protect your assets? $188, $199, I'm sorry, $188. You have a one-time lifetime setup fee of $99 and your first month payment for $89. What you notice here, ladies and gentlemen, there is no contract. So once you've reached the desired results that you're looking for, you can either stay on and enjoy the services that we offer, including the rebates that we give through our shopping boss, or you can discontinue. The choice is yours. Now, here's how you can get your services for free though. If you get results and you enjoy what we're offering and you tell 5 people about our services and they start to use the services, the very next month, your service is free. On top of that, we give back towards the youth financial literacy. So we take $2 from every $89 and put it back towards providing financial literacy lessons to schools across the US and educate students in the 5th through 9th grade on the matters of personal finances. Is that not important? Absolutely. Here are some of the things that we give away on an annual basis in terms of scholarships. 2016, 100,000, 2017, 170,000, in 2018, 250,000, in 2019, 250,000, and in 2020, over $400,000. And guess what? If you have a child that's a high school graduate and a college at the college entry level, you can also apply for those scholarships. So we're giving you ways to win, not only from a better credit score, but also giving your child a scholarship to help them on their way towards a better education. Now, does it work? Well, here, I'm just going to tell you some of our customers. First one is Debbie from South Carolina. She said, thank you for the excellent service you provided over and over again to the customers. I feel so glad and proud to be a part of this company. Your customer service is superb and consistent. Keep the good work. Let's pick one more. How about Roderick from Texas, down in the middle? He says, amazing. I signed up as a customer, and within 2 months, I had 11 items deleted from my credit report. I had several mortgage late payments that were updated to reflect as paid as agreed. As a result, I was able to refinance my home and save over $750 a month on my mortgage. My interest rate dropped from 14.75 to 5.75. Thanks a million, United Credit Education Services. I can finally breathe again after 7 years. Guys, that is a long time to be in a position where you've got less than perfect credit. And we showed you what that makes you feel like. You can imagine the anxiety he felt before he got to this level. So this is just some of what our customers are saying, and I would love to get your testimony. So take control of your financial future for what? Less than a cup of coffee. So if you like your Starbucks coffee where you're spending $5, $6, $7 a day on coffee, for less than $3 a day, you can get on track towards having better credit. So I want to turn this back over to you, Sandy, so that we can answer any questions they may have as it relates to NACA and how they can improve their scores and achieve financial freedom and financial literacy.
Okay, guys. Let me see if I could get to the questions, because there's a few questions that I have. Somebody's asking if we're moving from New York to Florida. Okay, so if you're moving from New York to Florida, you're gonna need to have a job in Florida, because NACA is gonna be looking for you to have a job here. So if you're getting transferred from the job you have there, that'd be great, because then that would be they'll look into the New York employment. But if you have to get a new job here, then you'd have to get a new job first before you apply, because they're gonna want to make sure that you are solid in a job, and you may want to work, in your new job here for about 3 months. If it's a transfer, not a problem. But if you have to get a new job, then I would say you'd have to come down, get a job, and stay in a job for about 3 months before you apply to them. That would be the answer on that one. Let's see. Beverly said she was in. Okay, Beverly. All right, so if you were in NACA before and you still have your ID number, Bev, all you have to do is let me know that you want to continue, and we could just start right back up. I just got to submit the form that I'm going to be your agent, and you probably will have to go back through that the house counseling, that 4-hour thing, because it's 2018, and every 6 months you have to renew with them. So I think you would have to redo that. So that would be great to pick them up from. I'm also getting some messages from Facebook, so let me see what they're saying. Okay, so somebody's asking if they changed job during COVID. There's going to be a lot of exception to this COVID thing, because it's nothing close to normal through COVID, and nobody has like a direct answer. So it's going to be a case by case. If you had a good paying job, if you could show that you were completely employed before COVID hit and you had to switch jobs by then, I'm pretty sure that would not be a problem because there's so much exception to this COVID period. So that's going to be that. Regarding what Wendell just went over regarding the credit, he has a great program that he's doing with the credit repair. For that program, it's $89, $88 down and 80. Am I saying it right? $89 down and $88 per month, right? If you want to get started with that, that's
$99 down and $89 a month. So when did you get to start? Go ahead. I'm sorry.
$99 down and $89 per month, right?
That's correct. That's correct.
Awesome. Right. So that's a great program you guys could get started in to try to rebuild your credit because credit is so important no matter what. And as he mentioned, as Wendell was mentioned, they have so much different services that they do with the program. So I would definitely look into that program. Again, you guys could email or text me if you want more information on that. I know we covered a lot and we're way over our time because it's supposed to be a 1 hour meeting and I know we're way over an hour, but I'm just trying to get as much information in as possible. I will send out a recording of this meeting for everyone. Somebody was asking if they were self-employed. As long as you have a 1099 to show, your income, then that's not a problem at all because that's what they're going to go by. So they look at your 1099 in this particular program. This program was first designed for low to moderate income people, and then they extended it out, and that's why they have the priority and the non-priority members. But they will look at your 1099 and determine where you would be with that. So that's what I would do. Does anybody else have any other questions, or am I missing any questions? Let's see. No, I don't think so. All right. So I think I'm going to end the meeting. Again, I'm going to send out the recording and just reach me by text or email and let me know. You could just respond to the invite I sent you for the meeting. Just say, yes, I'm interested. And I'll call you and we'll do a one-on-one. And then from there, I'll get you signed up and we'll take it from there. I appreciate your time, guys. I thank you so much for joining us. We know that your time is very important and we appreciate that you spending it with us. Thank you so much. And I will see you guys. Hopefully next week we'll have somebody else on and we'll definitely be exploring how to get you in a home because that's the purpose of this whole thing, right? So thank you so much.